Good afternoon. On behalf of the Fed Tax Section, this is Thomas Treese of Laird A. Lyle, PLLC, and I'm serving as the current phone czar. Today's speaker is Nathan Wadlinger. Nathan received his bachelor's and master's degrees in accounting, as well as his JD from the University of Florida. He received his LLM in tax from Boston University. He currently teaches tax courses in the Master's of Accountancy program at the University of South Florida in St. Petersburg. Today's presentation is titled An Overview of Partnership Taxation. Time permitting, a Q&A portion will follow this presentation. To ask a question during Q&A, press *6 to unmute yourself. A CLE course code will be emailed out to all registrants following the presentation. Nathan, you may proceed when ready.
Thank you, Thomas. Thank you for that great introduction, and I'm really glad that I was invited to present today. I presented last year on this topic, Overview of Partnership Tax, and really I have two goals in mind. It's really meant to be a refresher for if you're taking the certification, the tax certification exam, but even if you're not, this is just to keep in mind, the general rule for partnership taxation because it can help all of us. Now, it's really important that if you can, to follow along with the document that was sent out emailed. If you can't find that email, as I mentioned, I presented on this last year, and on the Florida Bar Tax Section website, if you go under Calendar, CLE Materials, and then click on Phone CLE for February 22nd, 2017, I'm pretty much using the same materials I used last year when I presented. The only difference is there's a few slides that have changed, 2 or 3. I've updated it for the changes with the Tax Cuts and Jobs Act, and I'm going to make sure to mention those items as we go. But again, if you can't find those materials, if you go on the Florida Bar Tax Section website and click on Calendar at the top, CLE Materials, and then click on Phone CLE for 2/22/2017, and you'll see it's a document with over 100 pages. So you're like, how can we cover all this in 50 minutes and then have 10 minutes to present? Well, let's go ahead and get started so we can go through all that. Really, it's pretty much a slide. So as you can see, there's only about 7 topics we're going to discuss, and it's really the 7 general topics in partnership taxation. As we go through, I'll make sure to emphasize we're switching topics. So the first topic deals with classifying a partnership. How exactly do we know we have a partnership for tax purposes, for federal tax purposes? Well, we're familiar with different types of entities under state law that generally are taxed as partnerships. General partnerships, limited liability partnerships, limited liability companies. But even if you don't have one of those entities, if you look at Code Section 761A, a partnership is defined, not defined, but it includes a syndicate, group, pool, joint venture, or other unincorporated organization through which business, financial operation, or venture is carried on. That's a very, very broad definition of partnership. It's a lot broader than what we usually think of when we think of partnership under state law. Now, if you do have a partnership under federal tax law, it's possible to elect out of Subchapter K treatment, which is, as we know, what applies to partnership tax for certain investment companies, joint production, and securities underwriting. So, as I mentioned, and as we saw from the definition in Code Section 761A, it's possible that even though you don't have a partnership for local law purposes under state law, you can have one for federal tax purposes, where you're required to look under Subchapter K of the Internal Revenue Code. I've really created a 4-step process of how you need to go about thinking about this. So the first step is determine whether there is an entity. You have to first determine whether there's an entity. And really what we're trying to distinguish here, and this is looking under the regulations in 301.7701, but really what we're focusing on here is we're trying to distinguish certain contractual relations and arrangements loans with equity interest, leases with equity rent, tenancy in common. It's possible that certain arrangements, even though you don't have a partnership under local law, they might be treated as a partnership for federal tax purposes. Really what the Culbertson decision, and really what the law is focused on is two major things. First, is there a profit motive? Do the parties have a profit motive? And second, is there actual business? Is there actually a business operations going on? Those two things are really what we focus on to determine whether a certain relationship. So it's possible that some arrangement you have to rent property or contractual relationship could be determined to be a partnership for federal tax purposes or joint venture or whatnot. Now, just because something, again, is treated a different way for local law doesn't mean it can't be treated a different way for federal tax purposes. So if we don't have an entity, then it's not going to be treated as a partnership. It's going to be treated as a disregarded entity, and it's going to flow through Schedule C or whatnot on the 1040. So if we have an arrangement, then we continue to step 2. Now, step 2, we distinguish whether it's a trust. And I've put some items here. This is on slide 1.5, to look at ordinary business trusts and whatnot, and, what exactly we're getting at here. I'm not going to go through the specifics, but you always have to make sure that your entity is not a trust. Because if it's not a trust, then it is a business entity, and we continue to step 3. Step 3, we then have to classify the business entity. Now, business entity can either be under the regulations 301.7701-2 and -3. It can either be a corporation or a partnership or a disregarded entity, depending on how many owners, right? If you have one owner, then you're disregarded entity or a corporation. If you have 2 or more, you're going to be partnership or a corporation. Now, some entities are automatically per se corporations. These are title corporations. Usually, if it's under state law, that's a per se corporation. And also, the regulations go through and they specify that certain foreign entities based on different countries are considered per se corporations. So in step 3, if we don't have a per se corporation, then finally we get to step 4, which is an eligible entity. And that's where you get to the check the box item, where we all heard about check the box regulation. When you have this eligible entity, now we have to classify it. Okay? And if we don't classify the eligible entity, the default rules apply. And for domestic entities, and if you have 2 or more owners, and you don't make a classification, then you're treated as a partnership. But if you have 1 owner, disregarded entity. So single level of tax flow through. However, you can elect to be treated as a corporation on that check the box. Okay? There's some different rules for foreign entities and whatnot, but I just want to bring to mind that's important. So now we've determined, okay, we're subject to the partnership tax rule, subchapter K. We have a partnership for federal tax purposes. All right? Now, how do we proceed? Well, just so you know, there's some special rules for master limited partnerships, and I have a definition and whatnot and how that works, but just know generally about that. Now we need to look at contributions to partnerships and also formation rules. So there's a non-recognition rule that applies when somebody contributes property to the corporation in exchange for ownership. And no gain or loss is going to be recognized unless there's services that are provided, okay? And then we'll mention service providers in a little bit down the line, but it's important to understand that it has to be property in exchange for partnership interest. Now, note, nothing is said in there about control. You don't have to control the partnership, so it can be 99.9% ownership in the partnership, or it can be 0.00001% in the ownership in the partnership. It's either contribution, formation. You're going to have no gain or loss recognized. All right? This applies to both the partner and the partnership. This is under Code Section 721. Again, it doesn't cover services. Now, there's an exception for investment company, where a partnership is an investment company when at least 80% of the assets are investment-type holdings. okay, investment type holding. Now, just to compare the results under Section 351, Section 351 has a very similar rule in terms of non-recognition of gain or loss when somebody contributes property to a corporation in exchange for stock. However, that control requirement has to be met. Again, that's the huge distinction, is that for partnership tax purposes, there's no control requirement. Big difference. So if Section 721 applies, then we have to determine the basis of the partnership interest, and we also have to determine the basis of the property the partnership receives. So we refer to the outside basis as the partnership interest, what the partner's basis is outside the partnership. The inside basis is the property that's inside the actual partnership. Now, both of them are going to be carried over. We're going to carry over from the original partner that property they contributed. However, we're going to increase for any gain recognized. You might be wondering, well, when would you ever recognize gain? I mentioned on the previous slide, right, that under Section 721, no gain or loss is recognized. Well, what if there's some boot? If there's boot, which is anything other than partnership interest, right, whether it's cash or property the partnership is giving or exchanging, I should say, to the contributor of the property, that's going to be boot, and it's going to be considered possibly taxable. Now, if you remember when you learned about corporations, corporate tax, under Section 351, if there's boot, it's the lesser of rule, right? The lesser of the amount of boot or the realized gain, but you can never take a loss. Well, in partnership tax area, we actually have a separate rule. We actually bifurcate the portion, the transaction, into, okay, a partner is getting partnership interest and getting boot. And then we allocate the basis using that fair market value allocation of what the partner is receiving. We allocate that basis in determining and bifurcating that transaction. And the sale portion, which is the portion of the boot, that's actually what is possibly going to result in gain. So that's where you can possibly get gain that might be added on for Section 722 and 723 purposes, if you're wondering. Now, with respect to tacking, right, for the long-term, short-term, because you're going to see later on that under Section 731, the partnership interest is treated as a capital asset. For tacking purposes, if the partner contributes capital or 1231 assets to the partnership, then the partner can tack on the holding period of that property originally held. That can make a difference because it can be long-term or short-term when the partnership is interest is sold, making a difference. For the partnership, there's always tacking, okay? And it's always important to remember that if the partner ever contributes cash, well, yeah, there's tacking, but cash doesn't have a holding period. So it's a fresh start anyway. It's a fresh start regardless. The partnership interest starts as of the day of the contribution. That's when we start counting. Okay, what about the effect of liabilities? This is always an interesting topic, liability. Well, if a partner contributes property to a partnership and the partnership takes on, assumes, or takes subject to the liability, recourse or non-recourse, well, that's going to be treated as a distribution of money to the partner. So a decrease in the partner's share of liability, so liability relief, is treated as a distribution of money. If any other partners take on liability, and this, by the way, this applies also during the partnership operation. If any partner takes on liability of the partnership, then it's treated as a contribution of money. And that's going to be important for adjusting the basis of the partnership. And that's also something that's really important when you compare S corporations and partnerships, because as we know, S corporations, that's not the case. Partnership, that's a huge distinction, a huge benefit, is that you get to increase the basis of the partner for the portion of liability that that partner is taking on. So recourse versus non-recourse liabilities. We've heard about these. We generally know about these, right? Recourse, some partner or related person bears the risk of loss. And that's the key language under the regulations in 1.752. Non-recourse liability, no partner or related person bears the risk of loss. So really, what we're talking about here is the lender. The lender bears the risk of loss. The idea is that it's a non-recourse liability. Let's say the property is attached to the liability. If you were to purchase a building with non-recourse financing that's secured by the building, let's say you pay $1 million for it, and you secure it with $1 million of non-recourse financing attached to the building. The building goes down in value, and you haven't paid off any of the liability. Let's say it goes down to $900,000. You might just walk away from it. Who bears that $100,000 loss? The lender, because they're going to take that property back, but they're the ones that actually bear that issue. So now we have to determine, okay, well, how do we determine the economic risk of loss? Because that's how we allocate these liabilities. And we have to do this calculation every year, just so you know. The partner share recourse liability versus non-recourse liability. Because that can go into the basis and it can affect many other things. So for a recourse liability, we really look at the constructive liquidation test, which we assume that hypothetical, what if all the assets are sold for $0? I know it's like a worst case scenario. All the assets are sold for $0. Then we allocate the gain or loss, and we assume that all the liabilities are paid in full. So really, at the end of the day, on that hypothetical liquidation where the liabilities are paid, but all the assets are sold for $0, how does that affect, if we were to liquidate, who gets what amount at the end of the day, or who has to pay back in terms of the partners? Well, you look at that analysis, and that is what you're going to be focusing on in terms of how we allocate that liability for that year, is going through that hypothetical liquidation. Now, usually what you see happen is for a recourse liability, we usually allocate based on the loss sharing ratio. We usually focus on the loss sharing ratio, because the idea is if we're looking at this hypothetical end of the year liquidation where everything's sold for $0, well, that's going to be losses. We're going to usually focus on, for recourse, we're going to focus on the loss sharing ratio. For non-recourse liabilities, though, it's different because, remember, you might be able to walk away from a certain transaction where it doesn't really negatively impact you, at least not on the books of the partnership. So there's really a three-tier waterfall that the regulations in 1.752 really focus on. This is in 1.752-3. We first look at the partner share minimum gain, which we'll focus on. We talk about allocation. Then we look at the share of the Section 704C gain, which I'll mention in the allocation. And then we look at the profits interest or some other share of deductions attributable to non-recourse debt. So with non-recourse liabilities, usually we allocate using the profits interest or the profits ratio. And that makes sense because think about it. If you have non-recourse liability, think about that building example I said earlier where you bought the building for $1 million. Let's say you're a business. If your company is doing very well, you're gonna be paying off that liability. You care about your credit and obviously other things. So it's important that to focus on the profit sharing ratio for non-recourse liabilities, because when you're doing well and you're having profits, you're going to be paying off. But when you're not doing well and you have losses, and let's say you keep having losses, it's likely that you're not going to be able to pay off your liabilities. And then guess what happens? You're going to default, and the lender is the one that bears the risk. So that's why we use the profit sharing ratio for non-recourse liability. Economically, that's why. Now, note that cash basis payables don't go into the Section 752 liability calculation. You might be wondering, okay, what about accounts payable, those kind of liabilities? We're talking here about mortgages and the general liabilities attached to assets or taken out. So contributions, service provider. What if you contribute services in exchange for interest? So historically, we used to focus on capital versus profits interest. And we had Revenue Proc 93-27, Rev Proc 2001-43 with the Campbell and the Diamond cases. Well, the proposed regulations back in 2005 came out, and really, while they reversed the rule that for how we distinguish capital versus profit interest. By the way, capital interest, you're guaranteed, or I'm sorry, not guaranteed, but you look at what is liquidation value. Profit interest simply doesn't have that. There's still a safe harbor that allows an election to value the partnership interest in connection with the service at liquidation. So practically speaking, it still can result in the same way. The receipt of capital interest for services results in income to the recipient equals the associated capital account transfer. So really the focus now is we have to look at the valuation of the partnership interest when it's received. So if you're looking in the document, page 22, I have an example where I go through formation and contribution of partnership. I put this example in there to give you some numbers to kind of give you an idea of how this works. I know I've kind of summarized the rules, but I want to provide an example. You're welcome to take a look. What you see in there is, this example involves debt. We have a partner that takes on some gain because they had more liability relief, a distribution, and what they actually contributed. And we'll talk about distributions later on, but those are two separate things, the contribution portion and distribution. So take a look at problem 1 there on page 22. Okay, partnership operations. So partnership operations, we're looking at the day-to-day operation of the partnership, how the partners report the partnership and how the partners report their income, gain, loss, deductions, credit. So we have a bunch of sections, 701, 702, 703, 704, 705, and 706. 701 through 702 and 703 deal with the partnership and the partners, how they report their share of partnership income, gains, loss, deduction, etc. So section 703 requires the partnership calculate the income or loss. Now you might be asking, well, okay, a partnership doesn't pay taxes. Well, yeah, we all know that. Partnership doesn't pay taxes, right? It flows through to the partners. So why is the partnership calculating this overall amount of income and loss? Well, it's because of basis calculations for the actual partner. As we know, characterization is not different for items that go into basis. We don't have a breakdown of basis. Oh, we say this portion's ordinary and this portion's capital or this portion's 1231. It's all basis is basis. It's colorblind. There's no difference. There's no distinction. So we use that calculation to determine how we're going to allocate out certain things in the basis computation, which I'll show you in a few minutes. 701 and 702 really focus on the partner, or 702, I should say, focuses on the partner. The separately stated items, or the 702AA bottom line, as we call it, where you net all the ordinary things that don't have any distinction. And separately stated items, right, we know what these are. These are things that any possible taxpayer out there in the universe could have some distinction over other taxpayers, whether it's based on looking at the general rules of different types of taxpayers, or just, okay, something that's distinctly representative of a specific taxpayer, like Section 1231, which can have different results based on every specific individual taxpayer. So that's what separately stated is all about versus how we can lump it together in the bottom line, Section 702.8a item. Section 704 deals with how we determine each partner's share of items. We call this the partner's distributive share, which is basically an easy way to think about it is how we allocate the item. Allocations versus distribution. We're going to talk about allocations in a moment, but as you all know, we allocate items every year to partners, even if they don't receive distributions of cash or property or whatnot, and they're still potentially taxable they're going to be taxable on the allocated amount. 705 deals with the partner's outside basis, and 706 deals with the taxable year of the partnership. So I mentioned the separately stated items. We have the Form 1065, which is what the partnership prepares, and the K1, and that flows through. Again, I'm saying stuff that everyone out there knows, but again, this is just meant to be a little refresher, just get the brain moving, thinking about these things. Now, a taxable year of partnership. The idea here is, if you think about the rules of partnership tax, when we had the codification of Subchapter K in 1954 Internal Revenue Code, really, we had this push and pull of two themes, aggregate theme and entity theory, or entity theme. The aggregate theme is really all about, okay, the partnership is just made up of a bunch of partners, and they should be reporting the various items of the partnership. Entity says, now wait, the partnership is an actual separate legal entity, so why don't we actually have to report everything at the partnership level? So what you see is certain rules have the different push and pull. Some rules have hybrid approaches. Other rules are solely entity and or aggregate. For example, separately stated items is a perfect example of something that's an aggregate theory. We report all that stuff specifically to the partners because they can have distinctions on their respective tax returns because of those items. Determining the taxable year of the partnership is an entity theory rule. We determine the taxable year of the partnership at the partnership level and that's how it's going to flow out for all the partners. Okay? Now this is done for many reasons. One is anti-abuse. Some taxpayers would want different year ends because they could defer income as long as possible. Other reasons are, okay, well, this is just an administrative nightmare. Imagine hundreds of partners in a partnership and having to compute all these issues when different partners have different year ends and flowing out and whatnot. That'd just be a nightmare. So we calculate the taxable year for the partnership under Section 706A and 706B. So really, it's a three-tier waterfall approach. Waterfall being you go through Rule 1. If Rule 1's met, you stop. If you don't meet Rule 1, you go to Rule 2. If you meet Rule 2, stop. If you don't meet Rule 2, go to Rule 3, and Rule 3 will work. So the first test is the more than 50% of profits and capital. Okay? So if a partner or partners that own more than 50% of profits and capital interest have the same tax year, use that year. The second part of the waterfall is if Rule 1 is not met, is the principal partner test, which says that if all partners that own 5% or more, you got to be careful here, right? One's more than 50% and one's 5% or more. 5% or more of profits or capital interest. If all of those principal partners, 5% or more, have the same year end, you use that. If Rule 1 or 2 don't work, then you use Rule 3. Rule 3 always will work. It's the least average deferral test. What we do is we do a weighted average approach, and we go through and determine what is going to be the year end that creates the least aggregate deferral. Deferral, again, some taxpayers want to get this deferral because it provides tax incentive. So there's anti-abuse rules basically at play here. And again, it's a weighted average approach. There is a supervening rule for the natural business year where if at least 25% of gross receipts occur in the last 2 months, and this holds true for preceding 3 years. Perfect example of this, I always tell my students in class, is you always see like those Halloween costume shops pop up September, October, right? They do almost all of their business those 2 months, right? They probably can get October 31st year end under that test. Even if their partners are all individuals, they have a 12/31 year end, and under 706B, they have to apply 12/31 year end under that test. So this is a way that you're going to adopt a natural business year for the business. So next thing is the outside basis calculation for Section 705. So we always start with the beginning balance of the partner's basis, outside basis, right, that basis of the partnership interest, which flows over from each year, or if you're starting from the beginning, it's whatever that basis was under Section 722. We adjust for the portion of the Section 703A, the partnership calculation of overall items, and we also add tax-exempt items, and we subtract away, we also add contributions for the year. We subtract away the share of any losses or non-deductible expenses, and also any distributions that occur. Okay, so limitations on the use of flow-through losses. This is really important because if a partner has a loss and it flows over, it might not be able to be utilized on the tax return of that partner. Because we have really a three-part approach. The first is that we have to look at 704D. You have to do it in this order. 704D says that a partner cannot take a loss on the tax return, his or her own tax return, beyond the partner's outside basis. Now, anything that's limited is carried over next year. I want to note that, and this is the first adjustment I have for the Tax Cuts and Jobs Act, but after 2017, this basis limitation applies to a partner's distributive share of charitable contributions and foreign taxes, which are exempted from such limitation under the current regulation. So now we're going to make sure that we look at that charitable contribution and foreign tax item as part of it. Okay, that's really important. That's an update from the change in the tax law recently. That's starting 2018 and on. Okay, 2018 tax years and on. Once you go through that 704D, the next thing is the at-risk limitations under Section 465, which deal really with non-recourse finance. We put a limit on that. And then finally, we have the passive activity loss limitations, which, as we know, under 469, we put it in the different baskets: passive, active, portfolio. And you have to look within those baskets. Okay, now we get to everyone's favorite topic, allocation. All right? So this is where probably you might be up to this point, oh yeah, I remember exactly all this stuff. Allocations, this stuff is what can be challenging, okay? And really what we're asking here is, in the partnership agreement, if it allocates income, losses, or we have special allocations like depreciation or various items a certain way, will it be sustained or respected? And you probably remember the phrase substantial economic effect. If the allocation has substantial economic effect, then it will be respected, okay? Now, I'm really presenting this in three different subtopics. We're going to talk about substantial economic effect, but then you're going to notice that there's some situations like non-recourse financing and book-to-tax disparities where it's just not possible to have substantial economic effect. So the idea behind the substantial economic effect is really that the tax numbers, whatever you're saying for tax purposes, should match the book, okay? Should match the book, how you're recording this for book purposes. The economics. Okay, that's why economics is part of it. The substantiality part of it is more about the tax avoidance or function, part of it. Okay, so first we're going to look at economic effect. You break down substantial economic effect into economic effect and substantiality. For economic effect, first we have the basic test. So these are safe harbor. The way to think about this is to meet substantial economic effect, you first look at safe harbor. If you don't meet the safe harbor, then you go to the partner's interest in the partnership. If the partner's interest in the partnership doesn't work, then we might have some special rules for non-recourse financing and book-to-tax disparities. That's really how it works. So right now we're focusing on the safe harbor. So the first test under the safe harbor is the basic test. There's three requirements for the basic test under Reg 1.704-1B2 little 2IB. You have to maintain capital accounts according to the regs in 1.704. You have to have liquidating distributions according to positive capital account balances. And if there's any deficits, they have to be restored unconditionally. Okay, so you're thinking out there, well, most partnerships, if there's any type of limitation on liability, that's not going to happen. So now we have the alternate test. The alternate test says the first two requirements of the basic test. Which are the basic test, the first two requirements, you maintain capital accounting according to regulations, which that follows, it's really close to financial accounting, okay? And the second requirement is that any liquidations occur according to positive capital account balances. So those two requirements are met. But the third thing, if you fail the third, which again is an unconditional obligation to restore any deficit, if you fail that requirement because maybe you're a limited partner, you have some type of limited liability, then under the alternate test, as long as you have the first two requirements I mentioned in a qualified income offset, I'll talk about that in a moment, then it'll be respected. Substantial economic effect will be respected. Okay? So qualified income offset really deals with if you have some type of event that's unexpected, a distribution, or you expect to have an income in a year or whatnot, and it would create a partner that shouldn't go negative, it creates them to go negative. Qualified income offset creates a hypothetical income to offset that to give it a zero balance, and that partner is zero balance. Okay? That's really what it is. And it gives the other partner that can go negative, if that's what you have in that circumstance, can go negative, it gives them income. Okay? I'm sorry, it gives them a negative. It gives them a reduction in the capital account balance, and that's how you determine your allocation with respect to that. Okay, so that's the economic effect, and that's really plain vanilla. Of course, we're going to talk in a moment about what happens about non-recourse financing because the economics don't really match what you're trying to do. So substantiality is again focused on tax avoidance, and really what you're focusing on is there's really shifting and transitory allocation. Shifting allocations, you look at items that affect the same tax year. Transitory affects multiple tax years. You look over time. Shifting, really what you see is when different partners are in different tax brackets and you're allocating certain incomes to different items. Really what you focus on two things. Would the allocation have a present value tax benefit than other ways allocation could be allocated, but also does it affect the same way as some other allocation would for capital account purposes, for the book purposes? That's really what you focus on. If those two things are answered yes, then really substantiality fails. Now it's a little bit more subjective than that. Substantiality is a little more subjective than economic effect, but that's really key. Okay. Now, as I mentioned earlier, if we fail to the substantial economic effect safe harbors, basic test or alternate test, then we have this partner's interest in the partnership, which under the regulations, if you look at a bunch of different factors, under Reg 1.704-1, relative contributions, all these different things. It's really tough to do. However, through the regulations, we do have a little bit of some insight. If you're trying to do partner's interest in the partnership calculation, and you meet the first two requirements of the basic test, again, capital accounting is maintained, and the positive capital account balances on liquidation are what follows, then we can apply the hypothetical, we compare the hypothetical book value liquidation at the end of the year. And based on who gets what at the end of the year, that makes a distinction, and that's how you allocate. You look at the beginning of the year versus the end of the year, and who would get what if we had a hypothetical book value liquidation, applying, again, that positive capital account balance rule, because that has to be there, right, to get there, and who ultimately is affected by what, and that's how you can allocate. Now, non-recourse liabilities, really the books can't follow the allocations a lot of time, because if you're allocating something related to non-recourse financing and the partners aren't responsible below, when the book value goes below the actual amount of the liability, we have to have some other type of measure, okay? Because we can't allocate anything to the lender because they're the ones that bear the risk economically, if you think about it. We can't do that. We can't go on the books of, in the tax return of the lender and actually change that for them. So I have an example on slide 4.15, and really it focuses on, an example and says, okay, what happens in year 3 when the capital account balances are now 0 to the partners? Can we allocate, the 90 to the limited partner and 10 to the general partner like we've been doing? Well, there's a safe harbor for non-recourse deduction. You have to meet either the basic or alternate test. You have to allocate. So if the non-recourse, so again, the issue here is what if you have some type of special allocation for, maybe you give more depreciation to one partner over another, and this is on non-recourse financing. If it's reasonably consistent with other allocations having substantial economic effect, then that will be met, and there has to be a minimum gain chargeback in play. So reasonable, consistent, that's usually within a range of what else is out there that's being allocated. So I show you how to calculate this minimum gain chargeback because that's what you have to have in the provision, and that's really the key. That minimum gain chargeback, that's what can create potentially, okay, you're getting this benefit as a partner, you sell your interest later on, okay, well, you have to take that into account, your partnership minimum gain, or some event occurs later on where you trigger the partnership minimum gain, and the partner actually does have to recognize gain, even though they got those deductions in a previous year. So I go through and I slides 4.17 to 4.21, I actually calculate how you go about doing that, and you can look at those slides. But that's really non-recourse financing, what happens. Okay, it's a special rule for that. Now, book-to-tax disparities, they create all sorts of headaches because if you think about it, when you have a book-to-tax disparity, all right, someone usually contributes, what happens is someone's contributing property to the partnership, and there's already either a loss or gain built in. And really where we see this is where you have depreciation allocated, where the book amount is different than the tax amount, the basis, because if the partnership buys the actual property, those amounts will start out, cost basis at the same, but when it's contributing to have this disparity, it's not going to be the same. This is very common. So what we do is, and I have an example on right after slide 4.28 that goes through this, and I really highly recommend if you're trying to figure, refresh yourself on this, looking at that example because it goes through all methods. There's really three methods: it's traditional, remedial, and curative. And really what it does is it says, again, we need to focus on the book. We need to focus. The tax numbers need to match the books. The books are key, right? That's the economics of what's going on here for allocation purposes. And that's what tax should follow. Well, the issue comes up, okay, well, if we follow a book, well, the numbers just aren't there. So what do you do? Well, the non-contributing partner, we try to mirror the books as much as possible. The contributing partner is the one that we can, that we ultimately, any adjustments need to go there. That's really how it works. So there's really three methods: the traditional method, the curative method, traditional method with curative allocations, and remedial. And as I go through on the examples, the traditional method, I have some steps. I have 4 steps. Trust me. Look at the example after 4.29. I go through step 1, 2, 3, 4. That's how we apply the traditional method with the ceiling rule. Then we have the traditional method with curative allocations, which takes income from other items with the same character and it allocates to create ways where we can avoid this disparity, because the disparity is created through the ceiling rule. And I have 1, 2, 3, 4, 5, 6, 7, 8 steps for that method. Finally, the remedial method has an 8-step approach again, but if you, the traditional method of curative allocations, you have to have that same character. If you don't have that, it can create hypothetical items there. Okay, so now next topic, payment from partnership to partner. And this one is pretty easy, and if you're having trouble understanding it, I have some examples that go through it. So if you're thinking about continuum, so I'm going to do this in 2 minutes, this topic in 2 minutes. Thinking about continuum, we're talking about any payments from the partner to the partnership. On one end, we have the normal distributions of Section 704 allocation, okay, how things are allocated. We already talked about how we allocate those things. On the other end, we have payment from the partnership to the partner where the partner is not in a partner capacity. The partnership is going to get a deduction for those things. The partner is going to apply his or her method of accounting. But what happens if it's a guaranteed payment? You're in the middle of that continuum. So there's 3 different possibilities. Again, distributive share, 704, we apply. We have partners, partner getting a payment from partnership when they're not in the role of their partner duties. And then finally, the guaranteed payment where a partner is getting paid for services or capital, but it is in the partner's capacity. So we treat it the same as we would for the partnership to the partner outside, not as a partner treatment. However, there's a few exceptions. We apply the partnership's method of accounting. Also, the partnership might not be able to deduct. They might have to capitalize any payments. And then also, the guaranteed payment is always considered ordinary income. So I have some examples, example 1, example 2, and example 3, which I highly recommend going through. And it shows you how, it's a realtor and a lawyer, and they form a partnership with, with rental property. And basically, in the first example, it's a normal distribution, just rental income allocated. Second example, now a tenant's suing the partnership, and the partnership hires B, who's a lawyer. B is partner B, and it's outside the scope of the partner's duty. And then we have a portion that's allocated through distributed share, and a portion that's considered partnership to partner outside the partnership. And then example 3, we have a guaranteed payment because after several lawsuits, the partnership agreement's amended, and then you see, okay, well, the partner, we're going to make it part of his or her duty, and then you see how it changes. Now, there's also disguised payments, which I talked about example 4 and example 5, and really it's ways that, people have tried to, okay, well, I can get around these rules. Well, it's kind of an anti-abuse rule. Okay, sales and transfer of the partnership interest. So when we talk about sales, we're talking about, okay, you have a partner selling his or her interest to a new or existing partner. We're not talking about redemption, okay? Now, I have an outline of the code provisions that apply: 741, 742, 743, 754 election, and 755, how you apportion that. Now, there's really 3 steps you always have to follow when you do a sale calculation for the partner. Okay. Step 1, calculate the overall gain or loss under Section 1001, taking into account any liability relief. Step 2, part of that can be treated as a 751 hot asset, which results in ordinary income. And step 3, whatever portion will actually take step 1 minus step 2, and then that gives you the capital gain or loss that the partner has to record. So step 2, so the issue becomes, okay, under 751, how do we calculate the ordinary asset portion? Well, 751A, we have unrealized receivables and inventory, which is any inventory. Unrealized receivables can also include, just so you know, any kind Section 1245 recapture. There's other things that are listed in there as well. So that's really important to understand. It's not just any accounts receivable, it's also other things, unrealized receivables, just so you know. And again, for sales or exchanges, hot assets or ordinary income assets, always inventory, any inventory. So I have some slides in there about, for the selling partner, the outside basis, some additional issues and what happens at the sale of the entire interest if the year closes and all of that. I want to note that the Tax Cuts and Jobs Act, after December 31st, 2017, Section 708B1B, which was the technical termination of partnership rule for when you sell more than 50%, a partner sells more than 50%, that rule is now repealed. So the partnership is now treated as continuing even if more than 50% of total capital and profits interest were sold or exchanged. No new elections or, you have to restart the stuff on the book or for tax purposes. You don't have to do that anymore, okay? That's been repealed. So what happens to the buying partner? So the buying partner takes an outside basis, but what happens inside the partnership is the outside partner that's buying steps into the shoes of the partner. And we have this disparity. We have a disparity in the numbers. And that's what the Section 754 election is trying to cure. The inside basis adjustment applies when you have a 754 election, also substantial built-in losses, which is also another adjustment of the Tax Cut and Jobs Act. After December 31st, 2017, the definition of a substantial built-in loss is expanded to include a hypothetical disposition by the partnership of all sale assets in a fully taxable transaction for cash or equal to the asset's fair market value if immediately after the transferee will be allocated net loss upon such hypothetical disposition in excess of $250,000. So it's expanded. So I go through the operations of the 754 election and how it works, how you adjust under 755. Please take a look at that. Really what it does is it cures that issue of that inside basis later on down the road. So I give an example, A, B, and C, and C sells of interest to N, and it's cured through, if you elect 754, because that portion will be, when that accounts receivable are sold later on, the partnership gets to step up the book number to $100, which was the portion that C, when leaving, already had to recognize. Okay, the last topic is distributions and retirement. So you got to break distributions down into simple distributions and complex. I also have some information on there about missing bowl and deceased partners, which I'm not going to be able to get to, unfortunately. But simple distributions do not alter any interest in 751 property. Complex do. We call these the hot assets, which are under 751B, which, just so you know, can be different when you look at the hot assets under the sale or exchange rules that we just looked at, specifically when you're looking at inventory. Okay. So I have the code sections for the outline. Liquidating versus current distribution. Liquidating is one that results in a termination of partnership interest. Current distribution is non-liquidating. So I have some rules: no gain or loss to the partnership under simple distribution rules. You can only be gained to a distributed partner if the cash exceeds the outside basis. Then the remaining portion is capital gain. There would only be loss if it's a liquidating distribution and there's no Tier 3 asset. The idea there is anti-abuse. We don't want to allow the partner to put more basis into the capital asset. So then I have a waterfall approach for simple distribution, how we allocate basis. So first you start with Tier 1, which is cash. If there's anything beyond cash, then you go to the ordinary income asset. and we carry out the inside basis that the partnership has. Finally, tier 3, which are non-tier 1 or 2, you allocate, if it's non-liquidating, then we use the tier 2 rule, and the rest goes to the partnership interest. But if it's liquidating, then those take the full remaining amount of whatever's left. Okay, so that's really the simple distributions. And I have an example of how 734 works, which is under the 754 election, how that can cure stuff. That's on slide 7.8 and continues. Distributions altering interest in ordinary income items. So 751B applies when a distribution increases or decreases the distributee's interest in unrealized receivables or substantially appreciated inventory. Unrealized receivables the same as sale or exchange, but it has to be substantially appreciated inventory, which is 120% of the basis. Now, if you have a situation where a partner is not getting his or her share of these hot assets, then you have to recast under step 1, recast the excess part of the distribution as imaginary distribution. Basically, you apply the distribution rule that they're receiving a portion of that. In step 2, the imaginary taxable exchange, basically they take a portion of that asset and they exchange it back to the partnership. So I go through an example on on 7.13 through 7.15, and that's the end of the presentation. So does anybody have any questions? If you have any questions, please press *6 to unmute your phone. No questions? Anything? Well, one thing I wanted to mention, you're still welcome to ask questions, but one thing I want to mention is I'm sure we all know about Section 199A and the qualified business income deduction. That's obviously going to have a big play with partnerships, specifically the partners, because you're going to be looking at the different, whether it's qualified business income and whatnot, and you're going to have to do that analysis. So that's with the new tax law. That's going to be a huge thing. Also, there's been changes with the new tax law under the carried interest rules. We knew this was likely coming in the legislation. We just didn't know what was going to happen. Well, now there's a 3-year holding period where if that carried interest, is not held for at least 3 years, then it's basically treated as short-term capital gain. And if it's more than 3 years, then it's going to be considered, it's going to get that long-term capital gain treatment, that preferential treatment. But practically speaking, did this really, fix this issue? I would say that, a lot of the hedge fund managers that are getting these carried interest, they probably hold it for more than 3 years, so it's not really going to have much of an effect. That's just my opinion. I mean, you might have seen this situation where they've held it for 3 years or less, so that might be a difference. So any questions on this presentation, please, I really appreciate questions.
Can we get the course number?
So the course number is going to be sent out through email, and I'm not sure exactly when, but it will be sent out through email. Any other questions? If you have a question, just press *6.
Do we have any idea if there will be a recording of this presentation posted somewhere later?
I believe so. Yes, I know that the session's being recorded, so yes, it will be reported later. The recording will be.
I have a question with regard to the new 100% expensing rules, and I was wondering in fact if a new partner is coming in and is treated like in a perhaps like a 99-5 scenario, if they're treated as acquiring assets, do they still get that 100% exemption deduction? Do they get to take advantage of the new 100% exemption rule to the extent that there's qualified property? Sorry, this is a random question in case you know.
I'm not familiar with that. But I had a little trouble understanding. Can you ask it again?
Sure. One of the new tax reform changes is the fact that there is 100% expensing for the acquisition of assets, new or used, as long as they're new to you and you're purchasing from an unrelated seller. And so if you have like perhaps a disregarded entity and you have a new partner coming in creating a partnership in like a 99-5 scenario, and generally the purchaser is treated as acquiring assets, correct? So I was wondering if you had thought of or if you've come across a scenario where a new partner is coming in a 99-5 scenario and they are allowed to expense under the new expensing rules to the extent there's qualified property.
That's an excellent question, and I haven't thought of that, but I mean I understand the issue. I'm going to look into that issue, and my email, if you go on the USF website, University of South Florida St. Petersburg, and you look up Nathan Wadlinger, my email's on there, and I'd be more than happy to talk to you about that because that sounds like a very, very interesting something. So I'm going to look into that. But I have no idea. I'm not sure.
All right. Thank you so much.
Any other questions?
Yes. Hi there.
Hi.
Can you please repeat the two things that you said were new under the tax reform package today?
Sure. So the first thing I mentioned was when we're talking about Section 704D, where the loss is limited to the basis. So effective in 2018 tax years and on, the basis limitation on deductibility of the partner loss for, if you have a loss and you're looking at the 704D basis limitation, this applies to the partner's distributive share of charitable contributions and foreign taxes. Okay? Because under the regulations before, foreign taxes paid and charitable contributions made are not taken into account in applying the basis limitation on partners' losses. Now they're part of that calculation. So that was the first adjustment.
Oh, okay.
The next item is when we were talking about sales or exchanges of partnership interest, when a partnership, when more than 50% of the capital and profits interest was sold or exchanged, the partnership was not treated as continuing, and the partnership basically terminated. Well, now that rule has been repealed, so if someone in a partner leaves the partnership and they sold more than 50% of his or her interest, capital and profits, now it's not treated as being terminated anymore, and you don't have to do all the new elections and whatnot.
Oh, okay. Great. Thank you.
Yeah. There was also, I mentioned another thing about substantial built-in losses for Section 754 applying to 743 for the sales. The definition of a substantial built-in loss, a $250,000 definition, that's been more broadly expanded, considering the excess. Really, those are the big changes for partnership tax. Not too big, but
okay.
Any other questions? Mm-hmm. No other questions? Well, Thomas, I think that everyone asked all their questions.
All right. Thank you, Nathan. That was a great presentation.
Thank you. Thank you, everyone, for listening in. I hope everyone has a great day.
Bye-bye.